Another AI stock bites the dust here after earnings. George Tsilis looking at C3.AI for us. GT, this hasn't really been a big winner all year, but of course it was on everyone's watch list at the end of 2023 into 2024. It was like this huge move from $10 to $50 at one point almost. So was it all like hype or what's going on?
Well, I'm not going to say it was hype, OJ. I think the reality of fundamentals, competition are starting to manifest into, I would call it the lower quality spectrum. Maybe if it's software services like AI, or if it's super micro in the hardware space. I think we're seeing the divergence of money moving towards quality names that are earning money, and that's again what I see here after the hype, frenzy we've seen a lot of these names. So reality is setting in, and I think that. The same goes, and this is the way it should be. If you're not making money and you're not expected to make money at the very least in the next year, in this case for C3.AI, they're not expected to be profitable until 2027. They're going to come at you with a meat cleaver, and that's what's happening here in the after hours. Now, looking at the print, you would say that things are better. They are. They posted a loss, an adjusted loss of 5 cents. The expectations was a loss of 13 cents. That was an improvement. Last year for the same quarter, they lost 9 cents. Sales were higher, 21%. They actually beat slightly the estimates, 87.2 million versus 87 million, slightly higher than 86 million. So I'm just rounding up. But that was, again, a slight beat, 21% increase in sales. But, you just look at some of the other headline figures. I mean, one, the guidance for the fiscal year, which they're in right now, this is Q1 of 2025. They slightly revised lower if you use the midpoint guidance. I have, in terms of sales, about 383 million. It looks like 382.5 million is the midpoint in terms of the guidance. But nonetheless, the expectations for sales growth is still 20%. But I don't see any changes in terms of their EPS guidance. And that's really what matters in these situations where obviously value matters, adjusted profits matter. And if you look at the report as well, just to give you some context, they lost $68 million on $87 million in sales. So that gives you an idea that gross margins, not necessarily gross margins, but net income margins are quite low. And if you look at the trailing net income margin, it's negative 90%. So it doesn't look like it was as bad this quarter. But nonetheless, there's still a lot of pressure on the financials of this business, and there's pressure on the stock.
Well, it seems like they're really they're like carving out their role as a major software player, where they've got some big contracts. They've gotten some, diversified customer bases. They've got over 430 customers now, and some fairly diverse verticals that they supply to, data analytics, some energy. Yeah. Baker Hughes is a client. Shell too. I know they provide some services to the government as well. So the growth is there, and it seems to be picking up from into the mid-20s, maybe next quarter up to 30%. But it just seems like they're sort of a nascent business, kind of like an up-and-comer in a way, where the market's kind of looking for more grounded, highly profitable businesses.
Well, that's the kicker. I'm not saying it's bad or never will be a stock that will be trending higher. I agree with you. I just think that it hasn't really established itself as an industry, separator from its competitors. I mean, if you look at Palantir, for instance, I'm just using this other software AI name a lot of folks are familiar with. They actually came out around the same time in terms of publicly traded. The 3-year charts look actually very similar, but if you look at the 1-year chart, Palantir is now moving higher at the very least on a 1-year basis, and even positive on a 3-year basis. Whereas if you look at C3.AI in the last 3 years, the stock is down 55%. Right. So the bottom line is profitability. Palantir is profitable, AI is not. But I do see that they expect to be profitable in 2027. It just happens to be that we're about more than 6 quarters away, and we're still about 8 quarters away before that happens. And so with that said, there's still going to be some overwhelming pressure to the downside, especially with short interest still at around 20% and net losses still quite a bit of a percent of total sales.
Okay, good analysis. All right, so look, they beat the estimate on the bottom line. Maybe there's a few things in here that look pretty good, the sales too. We'll see if the market changes its mind, but right now it's, shooting from the hip, asking questions later, seeing that there still is a negative number, there on the bottom line is just a turn off for the market. Right. All right, thanks, George.